Welcome to FXpert Trading, where I use time cycles, median lines, and other technical analysis to identify trade setups in the US stock markets as well as the FX markets. If you like the information contained within this video, be sure to subscribe for more. This is the NVIDIA daily chart. As I mentioned in yesterday's video, the target was 860 to 870, this upper warning line. We gapped up and achieved that target and rejected from the upper warning line. Despite hitting the target, it could still go higher. It does look like it might be putting in a shooting star, as does potentially the SPX. But considering how strong both of these are, you can't short either of those at this time, which is what I've been talking about in the last few videos. And what you have to do instead is pick individual tickers, like Apple. We'll take a quick look at the SPX chart, and we can see we've got our doji, and we may be putting in some type of shooting star pattern here as well. But you can't exactly call these tops, and again, that's why we're picking individual tickers. We'll review Apple today, plus a new idea for a trade I entered yesterday with the anticipation of some market weakness coming in. This is the daily chart for Apple. I mentioned in the weekend video that I would be closing my put spreads at the open on Monday, and that I would potentially be closing half of my puts at the open on Monday as well. And I did both of those things. The put spreads were closed at $1.13, resulting in a profit of 79 cents per spread. And that was for 2/3 of the position. The other third I had already closed on Friday at 68 cents, which was a 100% gain. Some quick math: 79 cents times 2, because it's going to be 2/3, plus 1/3 at 100%, which was 34 cents, divided by 3 gives us a profit total of 64 cents per contract. Divide that by the risk per contract of 34 cents per contract. It's a 188% profit, because again, I closed for 100% on Friday, and then 1/3 of the position for 100% on Friday, and then 2/3 of the position at the open on Monday. The puts that I had opened on Wednesday, which were 175 puts with an April 5th expiration, I purchased for $1.65 each, and I closed half of them at the open on Monday for $3.15 each. So again, if we do some quick math, 315 divided by 165 minus 1. I did the math a little differently this time, but it gives you the same result. That is a 91% profit. And as I mentioned, I only closed half the position with the expectation of further downside. Now, the reason why I only closed half that position, even though we may be holding this lower warning line that I discussed in this weekend's video, and even though we're just about at the expected 2-week trough, there is a chance that we do not get a good bounce here before selling off further. There is a chance this continues to sell hard all the way down, potentially to the end of this trough on March 20th. If it does sell hard, there likely won't be a good opportunity to add the other half of the position back on, in which case I'll be happy I only closed half and I can ride the other half down. If we do get a bounce, it could come in many ways, and I'll be looking to add that half back on in the same way I've mentioned in other videos. I'll look for it to bounce to a potential resistance area. We have roughly the 179, 180 level. We'll have this upper warning line. If we come below this lower warning line, we may bounce back up and then retest this lower warning line before continuing down. This was a scenario I had outlined in the weekend video where we could have potentially come up early this week and then back tested this upper warning line. And I mentioned in that video, you can do the other thing on the way down, where you back test a lower warning line that you break out of before continuing down. Either way, we'll be looking for a bounce back into some type of resistance, followed by a break of the prior day's low. I'll just look at these again. Daily low, higher 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 daily low. Once we break the prior day's low, that is a good signal. Again, not by itself, but using other technical analysis, including these median lines as well as general support and resistance areas, to determine a possible shift in momentum to where the negative momentum of the time cycle is taking over and you can possibly go short. So I'll be looking for something like that along those lines, whether it's up here and down or further down, then up and then down, to possibly add another half back on to the short side. The reason why we might not get that bounce and we might just continue to sell off with very minimal momentum back to the upside, giving us another opportunity to short this, is because of our break of the 200 SMA. And we're going to look at some historical examples to see what we might expect going forward. I've taken the drawings off and I've added the 200 SMA. And so you can see we broke below it, we back tested it and failed. We back tested it again and failed. I'm going to call this the initial failure because this is where we are initially separating ourselves from a meaningful way from the 200 SMA. I've scrolled out a bit and we're going to move left. We're going to go back in time to see what this looks like in prior examples when we break the 200 SMA in a meaningful way. Now this one is a little different because we were already below the 200 SMA. We briefly recaptured it before moving down. However, we broke it, retested it, and this is where we finally moved away from it in a meaningful way. And so if we start from the first candle after the retest down to the recent trough, this was 30 days and a little over 15%, a little over 15.5%. Based on our time cycles, we're looking for roughly 15 days, so this might be a little longer in time, but even if we were to look back over here at around 20 days, we're still talking about 13.7%. Let's look at another example. I'm just moving over a little bit over here. We break, we're a bit uncertain, and then finally this is the first candle where we kind of have our a little retest and we move down decisively. And let's do the same thing. We'll just measure that. We'll go from the 200 down to the low. This is 14 days and it's over 16%. Let's look at another example. We'll look at two more examples. This one is kind of like the first example where we had been below it, we briefly recaptured it and then fell below. But let's look from the retest down to the trough. It's 18 days and it's almost 11%. I might have gone a little low. No, I actually didn't go low enough. It is 11% at 18 days. This example over here, we get our little back test from the 200. This was obviously much longer. This was 48 days, but 26.5%. If we were to shorten that up, 24 days, and what percentage was that? 15%, over 15%, 10 days, 12.5%. Now, none of these examples are perfect, but they all suggest we should expect a drop below the 200 SMA of roughly 10% or more. Measuring our potential drop now from the last retest, and if we go 10% down, that puts us at 165.29. Now, some of those other examples did go further down in roughly the same amount of time we're looking for, but this should be potentially a good target based on the historical drops after losing the 200 SMA. I've added the drawing tools back on. I still have the measurement on here. Let's see how that looks if we were to extend to this trough down here. Using the median line set, that would actually be around 162 if we were to be touching the median line at the time of this trough coming in. Additionally, there is actually a gap down here. I've got it marked with this gray line at 158.49. That gap would represent about 13.6% down from the 200 SMA, which I think is a very achievable target. Does that mean we will achieve that target? No. Does that mean we will even achieve 170 as a target? No, not necessarily. But if we follow the time cycles, and the price seems to be reacting pretty well lately to the time cycles, that should give us some extra confidence to hold any open positions down into the expected trough around this time frame, and gives us some potential targets to where we should be looking to take profit if we hit any of those targets as we are approaching the end of this time cycle. Because again, these cycles are averages. They don't need to be hit to the day. They can be a few days off, so it could come in very early. So should we be at 165 on March 15th, Well, that also happens to align with the potential trough in the SPX. So that might be a good time and price to take profits. I'll continue to monitor and update Apple as necessary going forward. Earlier in the video, I mentioned another ticker to be looking at. I actually opened a position on this yesterday, and that is the VIX. This is the daily chart of the VIX, and I've talked about this before. Please ignore the time cycles on here. It's a bit of a coincidence that this came in on time. These time cycles can be helpful, but they're far less reliable than some other time cycles I use on other tickers. What the VIX is very good at doing is respecting trend lines and key levels of support and resistance. So while it's difficult to short the SPY or the SPX right now, as long as we get some sideways action or a minor correction that might not be very tradable to the downside in the overall markets, the VIX is something that can still spike pretty high and give you a nice trade opportunity. Here we can see the VIX had been supporting this level right here. We had this going back over here and all the way over here. We did have a spike below that, and that helped create this trend line that we have now respected once, twice, and we came pretty close to it over here. And though we did not touch it because we gapped up in the VIX, I went ahead and bought 327 calls at a 13.50 strike, and they were $1.26 each. As long as in that time period, which during that time period we are expecting at least a minor correction in the market, we should hopefully make it back up to this trend line that we have hit several times. And I do think there is a good possibility that we even return to this trend line. So what I'll be looking to do is close probably half of that position at about 15.25 and the other half somewhere around 16.50. Again, I'll be factoring in the time cycles on the broader markets in order to determine when I want to close these, and or if I perhaps close the whole thing down here or even somewhere lower should we start to run towards the end of those time cycles and we're just not getting the spike. But even during smaller pullbacks in the market that are not exactly great for shorting, you can get nice spikes like this, which can make for a profitable trade in the VIX. So let's actually look at this day. This is Tuesday, the 13th of February. This is the SPX daily chart, and here is that day, Tuesday, February 13th. This was just a one day, not even a huge pullback. I measured it, I think it was about a little more than 120 points from top to bottom, so 125, 126 points. Considering we're at the end of a longer term time cycle within, I'll go to the E-mini futures chart for a moment. This is going to be the blue cycle, whereas this was over here. This is just an orange. We should expect greater weakness and a larger pullback in this area, even if it isn't a huge correction or anything like that. And therefore, wouldn't surprise me if we got a spike like this or perhaps even more, but I would definitely be looking to take profit as we move into this trend line and or this trend line. Obviously, this one first, this one second. As always, thank you for watching this video, and be sure to subscribe for more.